Thanks for joining us on The Close. I'm Marella Fernandez. Markets close in a half hour's time. Let's get to some of the stories we're following in the BNN Bloomberg newsroom. At this hour, Donald Trump's meeting with top oil executives at the White House. In opening remarks, the U.S. leader praised last weekend's military operation in Venezuela and revealed 30 million barrels of Venezuelan oil worth about $4 billion are already headed to the U.S. He says the U.S. will decide which American oil companies will get a green light to drill in Venezuela. We're monitoring the meeting. We'll bring you updates as we get them. The Canadian economy added more jobs than expected last month. Statistics Canada says the labor market added 8,200 jobs in December. The gains led by full-time employment, mostly in healthcare and social assistance. But with more people looking for work, the unemployment rate rose to 6.8%. The U.S. Supreme Court did not rule on challenges to Trump's tariffs. Liberation Day tariffs placed levies on most imports. Canada and Mexico were also hit. A U.S. Supreme Court ruling against Trump could leave Washington on the hook for tens of billions of dollars in refunds. The White House has signaled it is ready to pivot if the court overturns the tariffs. Shares of Aritzia are up today after posting higher profit and revenue that topped Bay Street expectations. Revenue jumped 43% year over year. The clothing retailer also raised its full-year outlook. Aritzia says the results were driven by higher U.S. sales, digital initiatives, and marketing. We are in a position for yet another record close for the TSX. It would be the third this week. It's up 213 points right now to 32,592. Let's move to the south side of the border. The S&P 500, a 54-point gain, up 0.8%. The Dow Jones, a 258-point move up so far. That's a 0.5% move up. And the NASDAQ, 226-point move up, almost 1% at this time. The S&P reached a new all-time high today and is on track for a weekly gain after the latest U.S. jobs information or data report. Let's go to Diana Avigdor of Barometer Capital Management. She joined us now to talk some more about this. Thanks for joining us, Diana.
Hi, good afternoon, Marella. Thank you for having me.
Does a strong start bode well, strong start for the markets bode well for the rest of the year?
Yeah, that's what they say. I say this with a bit of a smile because, if there's money coming into the beginning of the year, is kind of the logic around this and people putting it to work. But the data set is that if the market makes a positive 5 days in January, in the beginning of the January, the data says that since 1950, the S&P averaged 14% with an 83% hit rate. So if we're part of the 83% and not the remaining 17, then the first 5 days of the year have been quite excellent.
Okay, so metals are on the move again today, gaining. I'm wondering what else you have noticed as far as the movers go.
There's some meaningful rotation that is going on underneath, and this is not new to 2026. The market did not know that December 31st, 2025 happened. So usually it continues in the way that it ended the previous year. And 2025 was full of rotations underneath the surface. We have Russell 2000 has outperformed NASDAQ 100, for example, but about 4% almost this year. The equal weight S&P has also done better than just the regular S&P, the capitalized S&P. And it played out in breadth as well, with 71% of S&P components closed higher as 70 for the Russell, whereas the NASDAQ 100 was a bit of a laggard. So money is flowing away from the Mag 7, let's say, and into a lot of other sectors, including reflationary, commodity-driven, financials and healthcare, that sort of thing.
You've also noticed money moving into Canadian ETFs. Why do you think that is?
That is amazing. This is part of our theme of global exposure, and we've been telling our clients that finally there is some real diversification potential in portfolios to be had. So Canada has outperformed the U.S. After U.S. has outperformed the rest of the world for many years, and 2025 was a year where the rest of the world, including Canada, has outperformed the U.S. It's not to say that one has to be down and the other's all up. It's just almost, an extra 10 percentage points. And in the beginning of this year, that theme continued. This was a data point from National Bank's ETF desk. Very big ETF flows coming into Canada. If we've had something like week to date, it was pretty big. It was like $5.3 billion week to date into the Canadian ETF market. For context, the 2025 weekly high was 5.9 billion. So to bring in 5.3 billion in the beginning of the year in the first 5 days, that is very big. And I think that just speaks to money, external money too, coming into Canada. We have a lot of things that the world nowadays wants, commodities, gold, silver, that sort of thing. And I think that is a theme that's playing out.
Okay, so I'm wondering what are the other sectors you think will do well? You sort of touched on that rotation of money going away from tech and into some other companies. And I'm wondering whether retail is one of them. We saw an incredible quarter report from Aritzia that is doing phenomenally well. And we know they've been expanding in the U.S. as well.
They've been, you look at the chart, they've done nothing but gone up for a very long time now. This is definitely a theme. They've reported some really, really great numbers. I heard you before I started the interview. 43%, you mentioned, quite right. $1 billion in revenue, and their expansion plans and e-commerce have been contributing quite well as well. And then they beat and raise. Guidance was fine, profit and margin improvements, and really positive investor sentiment around this. So margin expansion, operational leverage contributing to improved profitability has really been a good theme for the stock, and they continue to perform and bring in the fashions that people want. And they do all kinds of client comfort accolades, and people like to go shop there, and that is showing up in their sales and profitability and guidance and e-commerce and expansion plans.
Okay, let's get to one of your stock picks before I have to wrap it up. Lam Research is something that you like. They play into the semiconductor space. Tell me more about what you like about them.
Yeah, so, over in tech, we own Lam Research. This is a semi-equipment manufacturing company. It makes memory, all the stuff that the world needs. You see all the memory companies are doing pretty well. This is the kind of stuff we keep on needing more of. In the same vein, we also own Broadcom, critical supplier of custom chips, networking components used in AI data centers, memory and chips, and data centers. That is the theme of the technology vein that is going forward here.
Okay, I'm going to leave it there because I'm out of time with you, but thank you for your time, Diana. Diana Abdor of Barometer Capital Management. Coming up, new job numbers in Canada, why the unemployment rate went up, even though jobs were added. Back in a moment. The unemployment rate moved up in December to 6.8%, but Canada also added jobs, 8,200 of them. Let's talk about the numbers and how they could weigh on the Bank of Canada's January decision with Tiago Figueiredo, macro strategist at Desjardins. Thanks for joining us today.
Of course, thank you.
How do you interpret this? What does it tell you about the economy and where we are?
Well, I will say that these numbers have finally come down back to earth after three of the prior months being some fairly strong readings. I think that the number that we got today is a bit more believable. when you look at the details of the numbers here, it's tough to really glean much insight from it. I think the bottom line is really that we are seeing the labor market start to stabilize. I do believe that the labor force survey is probably overstating how much progress we've actually made on the labor market, but overall things aren't getting worse, and I think that's good news.
Okay, so when we look at the kinds of jobs that were lost, technical, scientific, and quite a number of them, versus jobs gained in manufacturing, does that provide any more clarity on sort of our economic strength in the country?
We do know that the trade related sectors have been hit pretty hard, although we've seen some stabilization there. Like those sectors are still reeling a bit. So it's tough. I mean, one thing that we are also looking through in this data is kind of seeing if there's any signs of spillovers into other sectors, like is the weakness spreading? And I don't think that's the case, at least with what we have so far. So again, it's kind of what I said, like it's a bit of a mixed bag here. It's tough to say. Like we've had obviously some improvement in the labor market, but nothing in here really suggests that we're seeing a remarkable improvement or something that would really push the Bank of Canada to start to contemplate potentially raising rates.
Let's talk about the youth unemployment, because they did see some gains October and November of last year, which people were happy to see after many, many months of being very low. But now taking a hit again. So would this be sort of a seasonal change, or what's your read on what happened there?
The youth unemployment numbers are, again, they're very messy. I think part of this is really just the story of non-permanent residents and this flow of people going in and out of the country. It's really tough to say kind of with any certainty with what's going on there. Again, the unemployment rate had been historically very high relative to other sectors, and again, a large part of that was that a lot of people coming into the country were people that were in that age bracket. Now we're starting to see some of those people leave, and that's putting some downward pressure on the employment rate. Again, the pop this time around, I think it's just noise in the data. Okay, so that's a staggered effect of people still leaving the country, perhaps with the immigration changes that had been announced. Does any of this change your outlook for the Bank of Canada and the rate cut path? Not particularly. Like I said before, we were a bit skeptical on the strength that we had seen in the labor market. I know the market had kind of rushed to price in a potential hike by the end of this year. I still think that the economy is still very vulnerable to any potential shocks. Actually, I think that the risks over the next kind of 6 months are probably skewed towards the Bank of Canada potentially cutting. It's not that I expect that to happen, but if we do get hit with some kind of shock, some negative shock, I think the policymakers wouldn't be afraid to lower rates. As we get into the end of this year, I think the story shifts a little bit. We start to see fiscal kind of pick up a bit, and that kind of shifts the risks a bit more. But at least in the near term, it seems like the Bank of Canada is really the only game in town to protect the economy if things sour. Okay. Is it your impression from your conversations that employers are still hesitant about the economy and are holding off on hiring? Yeah, that's still the case. And again, that's kind of one of the things where when we were seeing all these strong labor force kind of reports over the past few months, the hiring intention side of it, the forward-looking part of it, still looked fairly weak. So that's one of the things that I think hasn't changed, and it's probably going to get even muddier as we start to get a better as we start to hear more headlines around USMCA and the future of that agreement and what that can entail. Okay, let's talk about our neighbors, because they had jobs data come out as well today. There's growth, but it's very, very muted. What do you see forward for the U.S. Federal Reserve in that country? Yeah, I mean, again, the labor force or the U.S. labor market is, we're seeing a deceleration in hiring. The market's been paying close attention to the unemployment rate there. It's hovering around levels that would be consistent with kind of the FOMC's long-term kind of forecast. So there's not too much concern there, but I do think that downside risks still remain for the U.S. labor market, but the committee will be looking at this and be like, okay, the economy's not falling off a cliff. Growth's still fairly strong. The labor market slowing, but nothing too scary at this time. And I think the bottom line is that they probably still remain on hold, at least for the first half of the year. We still see them cutting going into the end next year, but I think in the near term, there doesn't seem to be much rush to lower interest rates. Okay, in Canada, what would be the thing that you're watching for that could sort of derail the economy even further? Is it perhaps if CUSMA gets set aside or that deal does not get renegotiated? Yeah, I think that's one of the big risks here. That's one of the big things that we're kind of flagging in the first half of the year as definitely a source of volatility, but also something that could definitely change the outlook going into the end of the year.
All right. Is there another big one you're watching, or is that the big one?
That's really the main one. I mean, there could be always other things that pop up with related to trade or anything else, but really, like the thing that shielded Canada has really been USMCA from a lot of the tariffs that have been implemented, and any kind of threat towards that, to the removal of that agreement or anything that would kind of push that agreement to be less concrete, is something that would be quite a material change to Canada, and I think that would kind of force us to adjust our outlook, and the Bank of Canada as well.
All right, Tiago, appreciate you joining us today. Tiago is a macro strategist at Desjardins. Coming up next, as we mentioned, the U.S. economy did add some jobs, 50,000. But what does it actually tell us about the American economy? That's next. The U.S. labor market added 50,000 jobs in December, below expectations, but the unemployment rate did fall to 4.4%. To discuss whether the report could influence the Federal Reserve's upcoming rate decision, let's go to Terry Wiseman, global FX and rate strategist at Macquarie Group. Thanks for joining us today.
My pleasure.
So a much slower pace of job creation in the U.S. Is this still sort of uncertainty from employers about the strength of the economy?
No, I would say that the job market data we've been getting is certainly not consistent with a significant slowdown in the economy. In fact, to the extent that we are seeing any indications of a slowdown in the economy in the last few months, it's been coming mainly from the labor market data. Most of the other data is not suggestive of a slowdown. In fact, you saw the third quarter GDP growth numbers come out at 4.3%, and the preliminary indications for where Q4 is going to come out in terms of GDP growth are also pretty robust right now. So, as I mentioned, there has been a slowdown in payroll growth, but in part because of strong productivity gains, and in part because that slowdown is mainly being driven by supply side factors and not demand factors. It doesn't seem to be consistent with anything approaching a recession, let's say, and largely because of that, there really isn't going to be any important need on the part of the Federal Reserve to cut rates when it meets later this month.
Okay, so there was a revision, as you know, of the 76,000 fewer jobs for October and November. That doesn't concern you then?
No, not really, because certainly the data collection process was affected by the government slowdown. The government shutdown. The government shutdown itself may have affected job creation, including in the private sector, not just in the public sector. So, but that was an anomaly. It's not something that was permanent. And as long as we do not get another government shutdown, let's say at the end of this month, at the end of January, then this should not repeat itself. Right now, the U.S. economy seems to be growing, at least in the latter, at the end of 2025, at a pace that's commensurate with maybe above 2%. And we don't expect a slowdown from there in the early part of 2026.
One of the unknowns that we're beginning to factor in, of course, is AI and the efficiency side of it, right? All the backroom jobs that could be lost to those upgrades in AI. Is that sort of contributing at all to your outlook for 2026?
Well, it's certainly contributing to the strong productivity gains that we might. It certainly could have been responsible for the strong productivity gains we saw reflected in the numbers that came out yesterday in the U.S. But I want to be cautious here. To the extent that AI has been affecting the job market, if at all, it's been affecting the job market mainly by reducing the pace of hiring, not by creating layoffs. So to say that there are job losses, that's effectively a nuanced view, right? They're only lost relative to where they might have been had there not been an AI revolution taking place. The other thing, of course, is that AI, to the extent that it is changing modalities with respect to how companies produce what they produce, it also creates some uncertainty. And certainly that uncertainty may have delayed hiring as well. But I want to be clear here. We're not seeing a pickup in existing workers getting let go. We are merely seeing less hiring. And for that matter, that less hiring is concentrated among new job entrants or supposedly new job entrants, people coming out of college and schools.
Do you see that changing, though? Do you see AI in the future, perhaps this year and into next, beginning to take more jobs where you could see the layoffs as opposed to just sort of reducing the hiring trend?
We certainly think that it could be something that affects the job market with respect to particular sectors. Certain sectors may be affected, but in an economy that's as dynamic as the U.S., in which wages are flexible and can adjust, we see AI prospectively producing job growth in other sectors. So the net effect, of course, is not going to be made clear for a while, but there's no reason to believe that on net we're going to see a higher unemployment rate, let's say, in the economy overall because of AI.
Okay, I do want to ask you about the U.S. Supreme Court decision that's expected on the American tariffs that were put into place last year. And I'm wondering whether you have a concern about the payback Washington could have to do if that court rules against the administration.
Right. So this is important because the Supreme Court has to rule on whether the IEEPA tariffs are legal, but also it has to make a ruling on whether or not the government has to refund the tariff revenue that was already collected in 2025 and partly in 2026. That could amount to about $150 billion. It's not all the tariff revenue that was collected. It's maybe a half to two-thirds of it, but it's not an insignificant sum. And of course, the federal government doesn't have just $150 billion lying around that it's been keeping in its vaults, ready to make that refund. The concern of the bond market, of course, is that if the Supreme Court orders the federal government to make those payments in fairly short order, the government will have to issue bonds, and therefore the supply of bonds will go up. To some extent, the bond market has been worried about that increased supply, but the Supreme Court typically takes into account the practical implications of its rulings. So even if it said that the government had to refund the tariffs, and there's no clarity on whether they will or will not, they may not say that it has to be done right away. It may rule or suggest or guide the government towards a lengthier refund period. And certainly the government may put impediments in the way of claiming those refunds, making it difficult administratively to file the claims for refunds. So we shouldn't be overly concerned until we actually see what the Supreme Court says and trust the court to make the right decision in this regard. Got
it. Terry Wiseman, sir, got to leave it there. Thanks for joining us today.
My pleasure.
Coming up the next, closing bells on Bay Street and Wall Street. Here are the closing bells for the end of the trading day. At the NASDAQ, Guard Nudie ringing the closing bell. And in New York, the New York Stock Exchange welcomes executives and guests for NCR Voyix Corporation, celebrating its 100th anniversary of its listing. In the TSX, or at the TSX, 10X Protocols ends the day. You're watching the close on BNN Bloomberg. I'm Morella Fernandez. Here's how we ended the day on Bay Street and Wall Street. Another record close for the TSX this week to end the trading week, 32,612. That's a 234-point gain and under a 1% move up today, but up 30% over the year. And the third record close for the TSX already this week. South of the border, a record close as well for the S&P 500. It is up only 44 points, but enough to hit the record of 6,966, beating a record from a few days ago. Let's get to the Dow Jones. It's got a 237-point move up, about half of 1%. And the NASDAQ, 191-point move, up 0.8 of 1%. 23,671 is where it landed. Let's get to the movers in Toronto. Endeavour Silver, gainer today, as are many of the metal stocks. It moved up over 9%, taking the share price to $14.80. It's up 191% over the last year. TerraVest Industries, also a mover today on the TSX. It gained over 6%, 6.7. That's a move of $10.56 a share, taking it to $167.52. First Majestic Silver also moving today. It gained over 6% and is up 211% in the last year. So ending the day, it's at $26.31. West Fraser timber is up today, almost 7%. It's up $6.01 per share, 92.36, and that is on news about an impairment of goodwill. We'll talk about that a little bit later in the show. Let's get to Celestica. It moved as well. It's up over 5%. That's up over $20.48 to $420.38. Let's go to Bloomberg's equities reporter, Stephanie Hughes, to talk about some of the movers on the day. Stephanie, a blowout quarter for Aritzia. They made that announcement after the close yesterday. Would Christmas have been included in their latest earnings report?
Hey, Marilla, happy Friday. Yeah, I would say that it would take, the holiday season certainly played a part of a role for the early shoppers, at least, because the quarter within 3 months did end on November 30th. So, yeah, people who got to it early enough would have been included in those numbers. But the whole breadth of the holiday season, including December, would be seen in the next fourth quarter. Nonetheless, it was still a very blowout quarter in the third quarter, like you mentioned. That was enough to bring Aritzia shares up by nearly 8% at their highest point. That brought the stock to an all-time high. So it's your classic beat and raise quarter. Adjusted earnings of $1.10 per share came ahead of estimates. And the company now expects that its net revenue could reach as much as $1.1 billion. That's up from their initial high of $1 billion. Also, analysts have been calling it an exceptional quarter with robust revenue growth, especially since they rolled out their mobile app that's been really driving that e-commerce growth. That and they added a new product offering and changed their inventory a bit, have had a really good pipeline of inventory that helped drive Canadian sales up by 29% since last year. So people are definitely liking what they see. They are pulling it off the shelves there. So that's obviously resonating with customers. Aritzia has had a pretty solid run in the past year as it's been engaging in this turnaround story and embarking on that strategy. And clearly, it's finding buyers in more ways than one, since that stock is up by about 127% over the past year, last time I checked on the terminal, Morella.
Yep, it seems that women do like buying their Aritzia clothing for both office and at home. All right, let's get to AG Growth because stock was flying there. What triggered that?
Yeah, so the shares gained by nearly 33%, which is 33%. That marked its biggest gain of all time. Going through the company's history, you won't find another stock move of that size. That also helped bring the stock price to its highest level since November. So the company, which develops agricultural equipment like grain storage and other crop processing equipment, had a third quarter that came ahead of analyst expectations. Its sales were close to $390 million. That's ahead of the just over $350 million that analysts were expecting. The adjusted EBITDA was also a beat. And what made this quarter, the beat in this quarter particularly interesting was that there was a lot of angst leading up to the quarter because of filing delays and concerns. All of that seemed to be unwound now, just given the size of the beat that surprised markets to the upside. It also got a thumbs up from the analyst community, most notably Raymond James analyst Stephen Hansen, who raised his team's recommendation on the company to an outperform rating from a market perform rating. It's kind of like moving a stock to a buy from a hold. Hansen said that in hindsight, the filing issues and the cautious tone that the company took in the fourth quarter for the fourth quarter forecast is probably more so a tempest in a teapot. So maybe an overreaction leading up to the results that we saw today. So traders seem to agree that it's a strong showing, and maybe some of the concerns were overplayed before because we're seeing some strong double-digit gains in the stock, Marilla.
All right, Stephanie Hughes, have a good weekend. Thanks for that. All right, U.S. markets closed higher today. The S&P actually hit a new record. Investors looking at some key economic data as well. We'll talk about that in just a moment. A record close for the S&P 500 and another one for the TSX. Let's talk about the start of 2026 with Keith Buchanan, Senior Portfolio Manager, Globalt Investments. Keith, thanks for joining us today.
Thanks for having me.
Okay, let's start with the jobs data out in the U.S. 50,000 jobs created, but slow growth, and then downward revisions for October and November of 76,000. What's your read on this data?
Well, it plays into a thesis that we've been building over the past year or so, coming into the end of 2025, and expecting soft landing to not look like the market was expecting. We just didn't look at it as a Goldilocks scenario. We looked at it as a scenario where there are more dispersed outcomes, expected outcomes of economic data, of Fed policy, and that would, really, convolute some of the expectations for the marketplace in a way that could make the recent 2 years run of growth kind of expanding valuation, and that's following through with earnings growth, to make it a little more complicated and a little more selective. And that's what we've seen, in our opinions, over the past 2 months. And it's really started 2026 in a similar manner. And that this data point this morning really fits that mold, and that some of the volatility around what this low hire, low fire market really means on a month-to-month basis, but also what it means to the broader macroeconomic story as well.
Okay, so what else will feed into the volatility, do you think, this year?
Sure. Monetary policy coming to neutral. We had conversations from Fed speakers that talked about us being very, very close to the ballpark of neutral. And as we come to that, we'll see a dispersion, as we've already seen in the last couple of meetings, of opinions of some of the policymakers, and some of the conversations that are more publicly facing will have more diversity of thought. That can lead to some confusion, but definitely not a consensus that is narrow as it has been in the past couple of years and pointing in one direction for monetary policy, which has been moving south towards neutral up until this point over the last 2 years. So as monetary policy starts to coalesce around this natural rate of inflation and natural monetary policy level of interest rates, we're really looking at what does the market look at next? Monetary policy moving south is a very clear picture for investing, but now investors have to be more selective, and we feel like that will follow fundamentals more so over the next coming quarters, more than it has in the past couple of years.
Okay, so because, as you mentioned, you heard the indication from the Federal Reserve that they are where they are, sort of for being neutral, what is your expected path for the Federal Reserve this year?
We're looking at 2 cuts, probably as we have a little more personnel change at the Federal Reserve. But over the course of the next 8 meetings, we see two cuts max. We felt like the risk to that is to the downside, though. And I think that's where the market and our shop differs in some way, form, or fashion, is that if we do end up with 0 and 1 cuts, what does that mean for the marketplace? It typically means that either inflation has become a little more stubborn than the market thought, or the jobs picture clears up to the extent of maybe mid-year to the later part of this year. We haven't seen a lot of that data come through just yet, and so we feel like there's a risk there that we can see that change and really surprise the marketplace. And that's what we feel like is probably the case that would lead stocks to have a little more volatility, and frankly, a little more of the value to growth to value, large to small, that we've seen over the last couple of months. We feel like that's been indicating a change in monetary policy. And we still see those changes taking place on a month-to-month basis.
Okay, let's talk about the start of the year in a wider sense. The S&P hitting a record high today. What sectors are you seeing money flow into? Is it a continuation of what we saw at the end of last year, where tech is kind of stalled and people are looking at everything and almost anything else?
Absolutely. We've seen value outperform growth from a Russell 1000 standpoint over 300 basis points. Small has outperformed large by a vaster extent, and just over the first few trading days of this year. So this is a very narrow and small sample set. But if the first part of January is any sign for momentum, it's definitely to the backs of the value, international, small cap names and sectors and industries that have been shunned, at least from a valuation standpoint, and not kept up with the large cap growth space over the last couple of years. So we see that continuing. I feel like that plays again into the macroeconomic picture that we've been setting up for over the past year and a half.
Okay, so what would you say investors are looking for? Are they looking for something less volatile? Or are they looking sort of to tried and true, or they can park their money, make a little bit of dividend? What are they looking for right now?
They're looking for things that make sense from a macro standpoint and also from a fundamental standpoint. So they're looking for cash flow generation that's better than the market median, if you will. Valuations that aren't top of the highest growth, names in the SP 500. So reasonable valuations. Looking at market cap outside of the biggest 12 names in the SP 500 as well. And we're seeing those names start to perk up in ways that aren't necessarily justified by huge momentum shifts in their fundamentals. Those stories haven't completely changed, but some of the charts and some of the pricing and volume has changed in a material way. So we feel like that attention is leaking outside of what's really carried today over the last 3 years. And we're excited about some of that breadth that the market is showing coming into 2026 and the start of this year as well.
Do you think there could be a bit of a turnaround with that? Because this has lasted now a few months, people moving away from tech, as you say, valuation concerns. But we definitely have seen that some of these companies have sort of what it takes for more growth. They're not sort of, as we talked about many, many years ago with the internet boom, sort of speaking about with nothing backing them. They have some backing. So do you think we could see a turnaround in a push back to tech stock later in the year?
Absolutely. Look, I can't take away the cash flow generation and earnings growth that's very, very real, and all of that AI-related names, also those adjacent to that story. The fundamental growth has been backed up. I mean, the sentiment has been backed up by fundamental earnings growth and cash flow that is very, very real and material. And we don't feel like that's going to fall apart anytime soon. We just feel like there's more growth as with a wider spread, 3 to 3.5%. Economic growth that we see coming out of fourth quarter, as that continues, hopefully in the first quarter. We haven't really seen a lot of deterioration on the momentum side there. That spreads out to spaces outside of the AI infrastructure build out that is very real and is tremendous, windfall for those shareholders. We feel like there's a lot more economic generation outside of those spaces. We want to make sure that we're there in order to take advantage of a valuation gap that has grown persistently wide over the last several years. And that catch-up trade could be very, very volatile and also, very beneficial to those shareholders.
All right, Keith, I got to leave it there, sir. Thanks for joining us. Keith Buchanan is with Global Investments. Coming up, the billion-dollar quarter that has analysts applauding Aritzia. Back in a moment. Shares of Aritzia are higher after a third quarter beat, a big one. The Vancouver-based fashion retailer reported about 90% jump in its third quarter and also hiked its full-year sales guidance. For more on that, we're joined by Martin Landry from Stifel.
The company is having a lot of success right now. Its products are getting a ton of traction. The results were very impressive. I mean, the same-store sales were up 34% year over year. That's one of the highest figures I've ever seen in my career. EPS came in at $1.10, up 54% year over year, so meaningfully ahead of consensus at 89 cents. So no wonder why the shares are reacting well today to these exceptional results.
We're looking at a market cap north of $14 billion right now. I mean, presumably the law of large numbers will catch up on them. They can't maintain this kind of growth forever.
That's sure. I mean, I'm not going to be sitting here saying that this is going to last forever. But one thing that, propelled their sales this quarter was the launch of their mobile app.
Right.
Believe it or not, it's the first time that the company has launched a mobile app. And it was a very successful launch. They had 1.4 million downloads in the last 2 months. The app was launched in late October, and this allows them to boost their e-commerce sales. Their e-commerce sales were up really strong, and it allows them to cater also the offering on the phone to the person that's shopping, and provide a better experience and probably provide a more customization of the offering.
It's interesting. So they had an e-commerce presence before, but just the fact that people can order clothes over their phones or at least look at products made that much of a difference?
Well, Andrew, I don't have to tell you that everybody is on their phone, and apps are very popular these days, right?
Yeah.
So you would have thought that Aritzia would have had an app a long time ago, like most retailers. But look, we saw this as upside, and we're seeing it in the numbers today. I mean, even look at their Canadian sales. their Canadian sales were up 29% year over year. And Canada is a mature market for Aritzia. The number of stores were the same on a year over year basis, maybe a couple of expansions. But to have sales up 29% in Canada, it's pretty impressive. And it shows that the company is gaining significant share.
And you say they have fewer than 80 stores so far in the U.S., and you reckon there's plenty of room to grow?
Yeah, well, we see Aritzia as one of the best long-term compounder in our coverage universe because they have a ton of reinvestment opportunities, like you mentioned. In the U.S., 72 stores. The company's talking about the potential to triple that number to 200. So tons of reinvestment opportunities, and with our return on invested capital north of 20%. Cash is going to compound really rapidly, and that's what we like to see, and that's what creates shareholder value.
And you say they're doing online sales abroad, but they haven't, outside the US and Canada, they haven't opened any brick and mortar yet?
Yeah, and that's another upside, another long-term potential that we see. The company alluded to it a little bit in the earnings call yesterday that, they have an international website, but no stores. And they're talking about countries like the UK, like Australia, Germany, Switzerland, and Asia, and China in particular. So you got to think that in the next 5 years, we're going to see Aritzia with an international presence and boots on the ground internationally.
And just remind us, what is their target market? Is it from young to older women?
Well, that's the when you step back and you're like, why is Aritzia having so much success? There's a couple of things that we can point to. First, the quality of their products, right? They're known for high quality, luxurious fabric. Their shopping experience, their stores are beautiful. They have cafes in some of their stores. And then the quality, when shoppers buy an Aritzia product, they know it's going to last. So they found a niche in the everyday luxury where customers are splurging a little bit because they're not cheap, those products, but they feel that this thing's going to last for a couple of years. It's classic. It's for your work day, for your outings with your friends on weekends, and for lounging at home. And it's from 17 years old to 47 years old. So it's a broad market and a broad occasions for that, and that's what created their success.
They just, there late last year, they opened in Manhattan's Flatiron district. It sounds pretty fancy, a 25,000 square foot flagship and soaring scallop ceilings. I guess you do want to have fancy stores in New York. That's a prestige thing.
Yes, it's a marketing tool. I would agree. And they've said that, their stores, their flagship stores, they've got 4 flagship stores, are like a really good marketing tool for them. It's also a great way to acquire new customers. These openings have been very successful for Aritzia. And last year they had a couple of them. So we're lapping these openings last year and seeing some really strong sales.
I guess we have to remember Lululemon, though. You remember, a few years ago, Lulu was posting sales growth like this. Rivals emerged. That stock has suffered lately. Yeah,
look, I don't cover Lulu, so it's a little harder for me to comment on Lulu, but I would agree that the fashion comes in cycle, and investors need to keep that in mind. But what we like about Aritzia is that it's classic offering, right? Very classical styles. And when you look at the company's balance sheet now, their cash balance has gone up to $650 million. It's, they have a lot of flexibility. They have a lot of room to redeploy capital and to give capital back to shareholders. So they're in a really, really good spot now. How long it lasts, we'll see. But like we said, we see it as a great long-term compounder in Canada.
Martin Landry is with Stifel. Coming up, West Fraser Timber announced a $400 million write-down for its U.S. lumber operations. We'll dig into why when we come back. The U.S. president meeting with American oil executives today at the White House. He wants a show of interest from them on rebuilding the oil industry in Venezuela. Trump also revealed that millions of barrels of that country's product is already en route to the U.S.
So we're going to discuss how these great American companies can help rapidly rebuild Venezuela's dilapidated oil industry and bring millions of barrels of oil production to benefit the United States, the people of Venezuela, and the entire world. And yesterday, the number is 30 million barrels. I can't even, is that correct? No? 30 million barrels. You hear that, Peter? Of oil was given to us by Venezuela. That's a lot of oil. It's about $4 billion worth, and it's on its way to the United States right now.
And Trump says U.S. oil giants will pour $100 billion of private money into reviving the industry in Venezuela, so no taxpayer funds will be used. And in return, Venezuela will deliver up to 50 million barrels of oil to the U.S., with Washington deciding which companies get to drill. Several oil executives also spoke at the meeting today. Chevron says it's committing to Venezuela's past, present, and future. ExxonMobil CEO calls for a win-win-win approach and signals a long-term view on investment. West Fraser Timber taking about a $400 million write-down associated with its U.S. lumber operations, citing challenging economic conditions. Let's go to Ketan Mamtora, an analyst at BMO Capital Markets. Thanks for joining us today.
Good evening. Pleasure to be here.
So this is referred to as a goodwill impairment charge. What does that mean?
Well, look, I mean, what has happened is we've had a very extended downturn in the sort of the lumber business, right? It's been 2 years that most of the public producers have had negative EBITDA. And this is much longer than anyone would have expected. So against this background where housing demand has been really soft, what West Fraser has done is basically reduce its long-term expectations of what trend pricing is, and that is what is kind of reflected in the press release last evening when they took the impairment.
Okay, so you mentioned sort of a repricing environment. Essentially, where else would they get that $400 million amount? How do they get to that?
Well, essentially what these companies do, when they have goodwill in their books, essentially what they are doing is they are looking at what trend pricing is for lumber and kind of what is the earnings power of those assets. So essentially what they are doing now is, given how extended this downturn has been, they are recalibrating those expectations lower, and that is what is driving this impairment charge.
Okay, how rare is this kind of charge?
Not very rare, I would say. In down cycles, this is when we see the most. So I'm not shocked that this has happened. The amount of the impairment is large, but during down cycles, this does tend to happen.
Do you expect to hear about more of these from other firms in that same business?
It is possible. It is possible that this could happen, especially companies that have done acquisitions in recent years, especially during the pandemic, when lumber prices were really strong, when housing demand was really strong. And so companies that have done acquisitions during this time, we could see some impairment from these companies.
Okay, that being said, shares moved up today. They gained. So how are investors sort of interpreting this news?
Well, I think today, in general, the housing complex, whether it is the home builders, whether it is the wood product companies, the building product companies, we had a pretty strong day. And some of it is driven by, the expectation that housing demand will pick up as mortgage rates will come down. We had from the U.S. administration, the president talked about, for Fannie Mae and Freddie Mac to buy the mortgage bonds. And if that were to help lower the mortgage rates, that would help to kickstart housing demand. We had also housing data that came out this morning. Both housing starts and building permits continue to remain under pressure. Year till date through October, both single-family starts and single-family building permits are down about 7% on a year-till-date basis. And we tend to focus on single-family activity because that consumes about 3 times as much wood as multifamily. And the key issue has been affordability. To the extent that mortgage rates come down, that will help to kickstart housing demand.
Okay, so we'll keep a watch on that. Is this stock a buy at this point?
Yes, it is. I like West Fraser a lot at these levels. Yes, housing demand has been weak, and we've seen a down cycle in commodity prices. But West Fraser is a well-run company. They've invested in the assets over the years. They've got a very strong balance sheet. They still have a net cash position at pretty much bottom of the cycle, and there is tremendous amount of torque that this company has to upswing in housing demand, to upswing in commodity prices, both lumber and oriented strand board, which goes into the exterior sheathing of the home. West Fraser is #1 in both these product categories. Prices are very depressed in both of these. So when housing demand improves, it is entirely possible that we see a pretty healthy pickup in prices for commodities, and that will help to drive EBITDA for West Fraser. We've seen capacity curtailments in both lumber and OSB over the last couple of quarters, and that is also helping to improve supply-demand balance. So I think the first leg of improvement comes from the supply cuts, and the second leg comes from demand improvement, which could happen in the back half of this year.
I was going to say, this is very tied, as you said, to the cutting of interest rates, which we, of course, know could not happen depending on what comes out and happens in the American economy over the next year. If there is no further lowering of the interest rates, do you think that this company will continue to struggle even to the end of the year?
Well, if we don't see any reduction in mortgage rates, then I think it is difficult to argue that housing demand really picks up. West Fraser is pretty well balanced between new residential construction and repair and remodeling, and both sides have been quite depressed. If we don't see any improvement in or lowering of mortgage rates, then I think from a growth standpoint, it's hard to see that we see a big jump. However, as I mentioned earlier, we are seeing capacity curtailments by several players in both lumber and OSB, and that is to kind of rebalance to this new demand reality. And that will help to at least modestly improve prices, which could help EBITDA for West Fraser and other players in the industry.
All right, Ketan Mamtora, thanks for joining us. Appreciate your time.
Thank you.
Coming up next, what we learned from CES, the Consumer Electronics Show in Las Vegas. Back in a moment. The Consumer Electronics Show wrapping up in Las Vegas after a week of reveals. Let's start there with tech analyst Carmi Levy. He joins us now. Carmi, the robotics seem to be big this year. Was any of it impressive to you? I like the laundry folding robot.
Yeah, I mean, LG's Cloyd, yeah, certainly it folds laundry and then it piles it up for you, which would certainly go down well in my house. And so, yeah, they were really impressive from watching the video. These videos went viral for a good reason. And this is a CES staple. Every year, companies like LG, like Boston Dynamics, which is owned by Hyundai now, bring their best and they kind of show how the technology has evolved year over year. But just like last year, there's no confirmation of how much these things are going to cost, when they're going to be available. And so, the actual creation of a market around these, we're still not seeing. And even though Hyundai did announce they are going to move the Atlas, which also starred in its own viral video, they're going to give it a starring role in one of the Hyundai assembly plants in Georgia. So there are commercial applications. They are in industry, not in the consumer space, which is what we've all been waiting for decades. So looks really cool. I still can't buy it yet. I'm not that interested yet.
No one's folding my laundry for me just yet. All right.
Not anytime soon.
You've also been looking at the chip makers, Intel specifically. What did we see from them?
So they introduced something called the Core Ultra Series 3. It used to be known as Panther Lake when it was being developed. And these are really important. Intel, as we know, in recent years has stumbled very significantly. U.S. government invested in them last year. They have failed to ramp their technology at the same pace as their competitors. And so while NVIDIA was busy figuring out GPUs and becoming a darling of the AI era, Intel essentially lost its crown as the CPU king. And so Panther Lake, architecturally, it's their first ones that are based on what's called the 18A fabrication process, which is 1.8 nanometers. So think smaller transistors that run faster, run cooler, are far more efficient. That's absolutely critical to having chips that are capable of handling these workloads. So very impressive architecture, a few years too late, but now it'll be interesting to see if they can ramp production to meet market demands and if they can at least start to catch up some of what they've lost in recent years. At the same time as they were announcing that, of course, NVIDIA was announcing its next generation of AI optimized CPUs, also a pretty impressive architecture. Qualcomm was moving its smartphone CPUs into the desktop and laptop space, and even AMD was introducing a next generation version of Ryzen. So the competition continues to move, and it isn't clear yet whether Intel has what it takes to reach its former glory.
Well, you mentioned that it's several years too late on this in a sector that moves so quickly all the time. We get announcements flying left, right, and center. So what would it take for corporate buyers to be convinced to go with Intel?
And that's exactly it. Every time Intel promised that they're going to be moving to a smaller fabrication architecture, they failed to meet those timelines. And even when they were able to develop them, they couldn't produce them at scale. And so Intel's going to have to prove to buyers that they can produce these things at scale. We're going to have to see the benchmarks because they've introduced the chips, but now they're going to be put in the hands of the experts who are going to run them through their paces and see, do they do everything that Intel has promised? And if that's the case, then yeah, buyers can have confidence as they outfit their data centers, as they outfit their people on the road, that yeah, this technology is now finally competitive and it keeps up. Because if it isn't, obviously, like Intel has to undo years of failing to meet expectations. It really has to over deliver on this one.
All right, let's get to a Meta purchase of Manus. Tell me about Manus. What do they do?
So they're a major powerhouse in what's called agentic AI. So they build platforms that create automated AI processes. So we think of AI like ChatGPT and Google Gemini. You type a prompt and it gives you an answer. What agentic AI does is it literally takes over entire workloads. And so Manus's sort of unique value proposition is that its platforms allow creation of those workflows. And it's one of the few AI companies that's actually generating revenue just a couple years after it was founded. And Meta loves the technology so much that they paid $2 billion for it. The fly in the ointment here, of course, is that they were originally founded in China, now based in Singapore. The Chinese government obviously has problems with this. They've announced they're going to be investigating this deal, and of course, this now becomes yet another flashpoint in trade negotiations with the U.S. Just as the TikTok deal comes to an end, hopefully by the January 22nd close date of that buyout agreement. So, it's a technology that could leapfrog Meta ahead by incorporating automation into platforms like Facebook and Instagram and WhatsApp. But it's got a significant number of regulatory and technological hurdles to go through before this thing gets the green light, if it ever does.
If it ever does. Okay, let's get to an announcement of an office closure in Halifax in the gaming space. Why is this significant?
This is really big, even though the numbers don't suggest that it is. So 71 people at the Ubisoft Halifax studios losing their jobs as Ubisoft announces that as part of a 2-year-long rationalization process, cost reduction process globally, that it just simply doesn't pass muster and they're going to close it down. But interestingly, this was a facility that only recently became unionized. And as we know in the gaming industry, gaming companies aren't very fond of unionized sites or facilities ways that can potentially increase labor strife as well as cost factors. Ubisoft also home to the Ubisoft Montreal studio, their largest global studio. About 4,000 people work there, center of an absolute powerhouse cluster of video game development expertise. And so it'll be interesting to see if there are any knock-on effects. Does Ubisoft's global cost reduction drive begin to affect Canada's leadership position in video game development? The company hasn't said anything. Of course, right now it's all speculation, but we're kind of waiting for that next step to happen. Certainly, if you're in Montreal and if you've been following the industry in Canada, this single announcement has landed like a bomb, and now everyone's waiting for the other shoe to drop.
All right, Carmi, got to leave it there, but thank you for your time. Have a good weekend.
Appreciate it, Morello. You as well.
So a massive deal brewing in the global mining industry. Glencore confirmed it is in talks with Rio Tinto, a possible merger there. More in a moment. Glencore has confirmed it is in talks with Rio Tinto on a possible merger. For more, we're joined by Ben Davis, head of European mining research at RBC Capital Markets.
This is actually dates all the way back to, I think it was 2014, when they first lobbed in a chairman's letter to try and see if something could happen between the two of them. But back in certainly last year, it got a bit more serious, but they couldn't agree on valuations. But with a CEO departure, a copper price rallying incredibly hard, and also the Argentinian investment environment looking a lot better, certainly Glencore as a basket of various assets looks increasingly attractive to the likes of Rio Tinto and BHP.
And it sounds like they're looking at all kinds of possibilities, either a complete merger or bits and pieces.
Yeah, they haven't quite given us the shape of it quite yet, and also what the price are. So they've got a month to let us know what that will be. But what for us, it would make most sense to do just a straightforward merger. We saw BHP last year try to attempt a merger with Anglo American, but stipulating various kind of pieces that had to happen with a spin-off of its platinum operations, its iron ore operations. Shareholders eventually pushed back on it and said, the premium that wasn't being offered given the complications. So I think Rio would prefer keep it simple, come up with a premium that is sufficient to get Glencore shareholders over the line, but at the same time, obviously not upset their own shareholder base that would be worried that they're buying assets at a premium after a very big rally in copper prices.
And also, I guess the other concern would I assume would be for shareholders, the coal. They've they've divested all their coal, and now they're looking at buying a company that's big on coal.
Yeah, it's the fashion of commodities comes and goes. With coal, there's you can discover nuance with coal. I mean, there's particularly over the last year, we've actually seen an incredible re-rating in the multiples in Australia and the US. It feels like we are moving past peak ESG, and also just from an energy security kind of perspective, coal is still a hugely important ingredient for the energy mix, where everyone is short of energy. So there's a argument to be made that actually coal is better suited belonging in these bigger companies that will responsibly wind it down when the time is right, and there's other energy options out there. So Rio's actually, there's been some media reports suggesting that Rio is willing to keep coal, which it would have, I think, surprised quite a few people this morning.
And how would that sit with investors? Would they be okay with that? I mean, they were the ones that pressured them to get rid of it in the first place. Or is 8 years, I guess, or 8 years enough time for people to forget?
Rio got out at a good price on their coal assets. I think given at this point time around, the big concern with coal is who you could sell those assets then to afterwards, and how much of are those assets stranded assets in terms of coal prices are going to collapse. Given where demand is heading, and continues to be incredibly robust even in the thermal coal space, there really isn't any danger on that. So I think for most investors, unless there's obviously some have incredibly stringent ESG hurdles within their own funds that they can't own those stocks, and that does affect Glencore. But for a Glencore Rio Tinto kind of merger, coal becomes a fairly small part of the pie, and it shouldn't be of any relevance, really, certainly at these prices.
And I mean, there's still growing demand. They're building coal plants in China right now like crazy, if I'm not mistaken. Who would win on this between the two, or can they both win on this?
I think they both win on this. I think Glencore wants it more than Rio. I think Glencore's been looking for an exit for a number of years, and the time is definitely right for them. For Rio, it also makes a lot of sense. I mean, it is incredibly hard to get copper exposure in the size that Glencore is offering. Once Glencore is in theory gone, say if that does happen, there are very few names out there which are of size that could either be taken over or also that are freely available in the markets. It really is the quantity that everyone wants, but it's incredibly hard to get hold of.
And just, I'm not sure if you can talk to this or not, the impact on Canadian operations, do we know?
At this point, no. I mean, certainly Rio, the biggest exposures that Glencore has, they have coal, the Elk Valley Resources coal exposure, which is a phenomenal asset, and there's also other bits and bobs that they have up there. I don't think there's any danger that this merger would change the scope of that at all. Certainly they both been pushing to have increasing Canadian exposure at this time.
And then what would be next if this actually does proceed? And then what about, are we going to see more mergers? And is this going to be the start of a merging year?
Yeah, it does tend to happen like that. If someone's stealing the last sweets in the shop, you're going to grab whatever you can, and as I said, there's not many others, and the others are potentially more complicated. We would suggest companies like First Quantum are interesting, but have we need the clarity around the Panama situation, but that would be another potential target for those looking out to get increasing copper exposure. And then just quickly, either company commenting at all or no? As of yet, we have had nothing beyond the statements that they are in preliminary discussions, and they will have to update us before the 5th of February. So it's going to be an interesting month.
Ben Davis, head of European Mining Research, RBC Capital Markets. The buzz around a Canadian hockey drama, Heated Rivalry, is heating up. A show described as shifting the conversation over inclusivity in sports, and it's become an international sensation in just weeks. Heated Rivalry isn't just a hit with viewers. It is boosting Canada's entertainment economy and showing the world our creative industry can compete. Here's more from CTV's Heather Wright.
And welcome to the show, Heated Rivalry.
Hudson Williams sat down on The Tonight Show with Jimmy Fallon and cracked a Canada dry. His Heated Rivalry character's beverage of choice, and a reminder of where one of the biggest shows on the planet comes from.
Is it sinking in how big this show is?
No. Showcasing the two most talked about prospects in the world.
Heated Rivalry, the breakout show about hockey rivals that develop an off-ice romance, debuted last fall, winning praise for its heartfelt depiction of LGBTQ2S+ relationships and sparking discussions about representation in both TV and sport.
To have this kind of a romance story portrayed inside the context of men's professional hockey at the highest level, I think will have an impact.
The show has exploded in popularity, the talk of group chats and Tinseltown.
You guys made amazing, original shows that everyone couldn't stop talking about until that gay hockey show from Canada came along.
And go ahead, Connor.
The show is an all-Canadian export, based on a book by a Canadian author, set in Canada, filmed in Canada, and produced by Crave, a subsidiary of Bell Media, which also owns CTV. Film critic Richard Krause says Heated Rivalry is an example that Canada can be more than just Hollywood North.
We're not just a production house for Hollywood productions to come here and shoot things. We can generate shows that can find a global audience.
Heated Rivalry has been picked up for a second season. That is the good news for fans. The bad news is that season 2 is not set to be released until next year. Heather Wright, CTV News, Toronto.
All right, let's have another quick look at the end of day for the markets. The TSX hit another record close today, ending the day at 32,612, moving up 234 points. The S&P 500 also a record close today, 6,966, a 44-point move up, 0.7 about of 1%. That does it for the close today. Thanks for joining us. We'll see you on Monday.